I read your quarterly report. You talk about a stellar performance in the upstream. So what kind of production are you going to be able to deliver for the whole of 2018?
Well, right now we're at 40,000 barrels a day. We expect to exit next year with at least a 10,000 barrel a day increase from conventional resources. And we expect to be able to substantially increase our production via strategic alliances, which we're about to go into now.
So substantially increase production by what? You're tempting us there with a number. How much up could we go?
Well, first of all, we're targeting at least another 50,000 barrels a day over the next 3 years. We've identified substantial reserves, which we know we can exploit. And we are close to securing the funding now to be able to achieve that. To
exploit the reserves, are there going to be more new partnerships announced?
Yes, I expect so. And the reality is that having worked so hard to delever the company, we had $800 million of upstream debt 3 years ago. We've substantially reduced that to less than $150 million. So we're gradually getting back into deal mode now.
As I was reading the stories about that debt, I got the sense that you're not a CEO that's in the mood to lever up the company again to do a deal. Are you open to doing deals, and would you take leverage again?
Well, I think the difference now is that we've been able to de-risk the challenge of exploiting Niger Delta onshore reserves. I mean, the indigenous companies are doing a wonderful job in terms of managing communities, dealing with local partners, getting better fiscal terms out of the government. And we're able to attract a wider range of capital sources, not just straightforward bank debt, which was our only source of exploiting our resources.
And in terms of the next project for you, is that going to be domestically, or is that going to be looking beyond the shores of Nigeria?
Well, I mean, right now, Nigeria offers us just too many opportunities. I mean, it's 35 billion barrel reserve environment in which is only 2 million barrels a day of production. So the challenge for Nigeria is to get its production to reserve ratio up. You know, the resources are there. We just don't have enough exploitation going on. So there's really no incentive for us to go to other parts of the continent as of now.
Let's talk about the market. Donald Trump has been on Twitter. Overnight he said he's hopeful that Saudi Arabia and Kingdom Saudi Arabia and OPEC will not cut production. Prices need to be much lower based on supply. What do you make of that tweet in response to what's happened at the JMMC and Khalid Al-Falih's comment yesterday about the possibility of reversing the supply?
I think what our market really needs is a stable price regime. People have to plan long-term investment horizons. You know, countries have, majority of the oil producing countries depend entirely on that resource as a big aspect of their income. So it's a bit ambitious to just expect supply and demand to be the only determinant of our industry. And we need to have a price that is reflective of our cost base, our tax base, and the fiscal incentives which we receive in the countries we're producing.
Where is that floor? OPEC talks about a corridor, but for you at Oando, where is that bandwidth? Is it $55 to $60? Where's your tolerance level for capex to keep you happy?
Well, I mean, $65 is where we did our planning at, and so I would say 70 is probably a right base, because when you consider that, you know, there's sanctions out of Iran, reduction in production from Venezuela, challenges in Libya, we live in a very sensitive world.
Do you think we're underpricing some of those risks, the waivers from Iran? Do you think we're underpricing supply outages? That's the debate at the moment, isn't it?
I think so, because if you look at this time last year, OPEC was seeking to reduce prices. Then by June, they were looking to increase production. And then all of a sudden, 6 months later, we're now talking about cuts. So it's clear that we're underpricing several risks, and we're probably a bit too ambitious regarding the sort of excess inventory levels which are being generated, particularly out of the U.S. shale. I mean, the U.S. shale, there's been a million and a half barrel increase in the last 12 months, and that's all technologically driven. So the reality is that we are, once the bottlenecks in terms of being able to export those barrels out of the U.S. is lifted, we're going to see a lot more oil on the market. And I think we do need to start to prepare for that in advance by managing the supply and demand flows within the global industry which we have today.